Thank you for joining us today. The call for today is to introduce you to Syntax Research. I'm your host. My name is Sandeep Sharma, CFA. I'm the principal and founder of Syntax Research. Before we begin today, I want to point out that the purpose of our call is not to solicit any assets or information or provide any specific advice to anyone in particular. It is merely to give you an understanding of the nature of the work we do. The agenda for our call today is to tell you a little bit about Syntax Research. What do we do? How do we do it differently? And why should you use our investment strategies? Most importantly, we like to talk a little bit about risk. We are risk managers, and we like to talk a little bit about how do we assess risk, how do we mitigate risk, and in certain situations, how we try to hedge the risk in our investment strategies. It is the most distinctive aspect of the nature of the work we do. So it should at least give you a better understanding about why our risk management is relevant to you and why it should be relevant to your clients. First of all, let me start by talking a little bit about that we are not your traditional asset manager. We are not a typical manager that provides asset allocation, or you can box us into a style box like large cap value, mid cap growth, or a small cap value and such. We are really dynamic risk allocators. The distinctive aspect of the work that we do is to provide a dynamic risk allocation, and that is done by assessing the investment opportunities and risk across all asset classes. These can be U.S. or international equities, U.S. or international fixed income. It could be gold, it could be real estate, and most importantly, our strategies also provide for the inclusion of investing against the market using inverse ETFs to hedge the risk from time to time. All of this is driven by our own global macro research. So in one way, we eat our own cooking. We know the research that we have done, and we have a better understanding of how to put it to work. We do all of this in a manner that is very low cost and very, very tax efficient. I'd like to take a few minutes and talk to you about the research model that we have, which leads us to assessing and understanding risk and reward in the stock market. So at the foundation, we are really fundamental global macro research analysts, where we assess the fundamental situations such as valuations of companies, corporate earnings, geopolitical risk, and then we do quantitative analysis to understand where might the risk come from. Is it coming from currencies such as the relationship between the US dollar and the euro, the dollar and the yen? Or is it coming from commodities such as oil? And in the equity segment, the risk may come from either the broad market risk, or they may come from certain sectors like the financial sector, or they might come from a particular country or a region. So we try to assess what is the impact, where is the risk coming from, how do we understand it, what is the magnitude of the risk, and what kind of an impact can it have in our own strategies. We also very carefully take a look at the global interest rate situation, how they're expected to behave in the U.S. and outside the U.S. So this kind of a framework gives us a sound understanding of the global aspect as opposed to only looking at domestic markets. And after we understand that, we try to assess the level of the risk. Some risk one has to simply absorb. That means that we cannot do very much about that. They happen rather quickly, and they cannot be hedged. Some risk can be mitigated by diversifying or using low volatility asset classes, and other risks must be hedged to prevent significant and catastrophic declines in a portfolio. So it's very important from our vantage point to understand how all of this is working. And why that is important is that when the markets do decline, net of fees, client portfolios still need to make forward progress. So in a situation where you have an asset manager who anticipates a lot of risk and uses market timing to their advantage, they might sell a lot of securities and move to cash to prevent the risk. We try to have a more steady approach by keeping core assets intact and in taxable accounts, preventing a lot of taxable gains, but we offset that risk by hedging the portfolio so we still have steadier returns, but we don't have too much by way of tax consequences to the client. As I mentioned to you, risk is very important because garden variety type of corrections, which is a 5 or a 10% decline, happen quite frequently. A 5% decline over the past 115-year history of the market happens about 3 times a year, and a 10% decline happens on average about once a year. So these are more garden variety corrections that are not necessarily the ones that one needs to hedge against. But the more significant correction, like a 15% or a 20% correction, which happen respectively once every 2 years or once every 3.5 years, are the more devastating corrections to client portfolios. And just to make a note, the last 20% correction happened back in March of 2009. So it's been quite a while since we had a significant correction in the market. Why we believe our risk management is very important and why we believe that timing the market is not necessarily the way to go is because we believe the approach we deploy in managing client portfolios provides for a more steady outcome. In this hypothetical example, if you consider an investment strategy that produces 6% year after year for 3 years and compare it to a more volatile portfolio that goes up 30% the first year, goes down 20% the next year, and then comes up 8% the third year. So 2 out of the 3 years, the volatile portfolio has beaten the steady portfolio. But when you look at the simple mathematical average, they produce exactly the identical return. However, when you look at the cumulative return, the steady portfolio has generated 19% cumulative return versus 12 for the volatile portfolio. And on an annualized basis, over the 3 years, the steady portfolio has beaten the volatile portfolio by 2% each year. Very briefly, I'd like to talk to you a little bit about the range of strategies we offer and how we deploy an understanding and application of risk dynamically, as well as why they are a better approach to an approach that might be assessing risk and addressing it by being very market timing oriented and going to cash and moving in and out of cash. So at the heart of our offering are 5 strategies that are called core risk target strategies because they target a specific level of risk. The first 2 strategies are conservative and conservative growth, and they target 40 and 50% risk of the stock market. The next 2 strategies are moderate and moderate growth, and they target respectively 66 and 80% risk of the global stock market. And lastly, we have U.S. equity focus, which targets 100% risk of the market. All of these 5 strategies are what I would say are the foundational part of the client portfolio. That means one can allocate an entire portfolio and not have to worry about picking asset classes and different managers. The distinctive aspect of all of these 5 strategies is all 5 of them can hedge themselves per the mandate of the strategy depending on the investment situation. So that allows us to keep the core of the portfolio very steady, but we can use hedging to mitigate the risk so that the outcome is a steadier portfolio without causing a lot of tax consequences. And at the periphery, you can see that we have some satellite strategies. Some of them use ETFs, some of them use equities. The first one is sector rotation. The second is select equity. The third is active equity hedge. And the last 2 strategies focus on investors who are looking for income approaches using multiple asset classes. Equity income hedge uses equities only and can hedge itself, and it is looking for growth companies that pay good dividends, but also provide for a steadier outcome. And yield focus does not hedge itself, and unlike equity income hedge, it uses ETFs only in a multi-asset class approach. That is the conclusion of our presentation. For additional information, please contact Cassie Waller. Cassie is our Chief Marketing Strategist. She can be reached at cassie@syntaxresearch.com, or you can call her on the phone 561-810-0220. Thank you for your time.